What's going on, everybody? We're back at it again. This year is winding down. This year in the stock market is winding down, but this is the time that we have to take the time to get prepared for next year and the opportunities that we're going to be able to seize, because we're going to be seizing a lot of opportunities in 2023. You can believe that. And so now is the time that we have to be making the preparations to do that. And so again, I appreciate everybody again that has been with me all year long. Okay. All year long, you all have been with me all year, listening to me as I try to provide value. And as I do provide value to you all in the stock market and things of that nature. So let's get into it again. Welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure that you please like this, okay? Please like this, please subscribe. This is going to help me with my channel, help me with the podcast and the algorithm. If you listen to it on audio, give me a 5-star rating. Apple Podcasts, Spotify, Google Podcasts, right? Go tap into the major podcast providers and provide me a like, provide me a listen to help me with that viewership so we can really get this podcast out to the people that need it the most. Now, this episode 49, 2023 stock market outlook. Okay. I prepared a presentation. We're going to go through things in this presentation. Okay. Now, what I want to tell you is that 2023 is going to be a year that's unknown. I'm just going to tell you 2023 is really going to be a year that is unknown, but I've got some ideas. I've got some things that I've gathered that I want us to really look at and pay attention to, because it's going to require us to do a lot of research this year. We're going to have to get into that research bag if we really truly want to be successful this year. So again, let's go ahead and share my screen and get everything started, right? Let's go ahead and get everything started the way we need to. All right, let's get everything started the way that we need to. So again, 2023 stock market outlook. Okay. What should we watch out for? Okay. So again, this is a presentation that I created that I want to put out here and just provide value. This is about providing value, giving you some ideas that I think you need going into next year. What should we watch out for? Now, what will this presentation include? Okay, this presentation will include my thoughts on stock market themes that I have gathered from various institutions across Wall Street: BlackRock, Charles Schwab, JP Morgan, State Street, big institutions, okay, that have been putting out research that I'm trying to gather and then, regurgitate to you all. Please note that anything discussed in this presentation is not financial advice, okay? And you should do your own research before investing into any financial instrument that will be discussed, okay? Now, I feel that the market environment is very volatile right now, and things could change in an instant. So you must be prepared for that if you will be an active investor heading into 2023. That's why it's very, very important that you all really do your own research, because everything that I have prepared for this presentation, everything that the big institutions may prepare for their outlook in their presentations, they might be throwing it in the trash by the middle of the year. They might be throwing it in the trash in the next 3 months, because anything can change in this environment. So that's why we have that's why this is a stock market outlook, but it's more so stock market ideas. It's more so stock market themes that I've just gathered from other people across Wall Street. And I think that these are the ones that we want to pay attention to, and the ones that are probably important. So setting the record straight, okay, this has been a bear market. Okay, we're in a bear market. Okay, and that's not, a secret. Okay, we're pretty much been in a 12-month bear market. The bear market that we are in right now is longer. We've been in a bear market longer than the average bear market. So it's pretty substantial. If you think about the 60-40 portfolio, the 60-40 portfolio where you have 60% allocated to stocks and 40% allocated to bonds, that has had the worst year since 1936. I'm going to say that again. The 60-40 portfolio with 60% allocation to stocks, 40% allocation to bonds has had the worst year since 1936. We were in the Great Depression during that time. Okay, let's just put all that into perspective. So that tells you how atrocious this year has been. However, my long-term thesis for technology and the companies that I believe will be growth engines over the next 5 to 10 years have not changed. Okay, the three companies that I like the most are AMD, Tesla, and Apple, along with other quality technology companies that I follow and that I research. I feel that the fundamentals of these companies can't be denied, and you cannot let one down year in the market scare you away. If we have another down year next year, I'm going to come back to you again. I'm going to say, look, we can't let 2 down years in the market scare you away. I truly feel that building positions in solid growth companies, quality companies at the levels they are at and the levels that they may potentially get to will prove to be rewarding over the next decade. Now, what are the themes from 2022 that will likely continue? We'll probably continue to have concerns about inflation. You know, inflation was a buzzword. That's all we talked about was inflation, how the prices are up at the gas pump, even though they've came down substantially now, how the prices are up with the food and how our prices are up with so many different things. We're still going to be talking about that because of the Federal Reserve's continuation of quantitative tightening, raising interest rates, letting bonds roll off of the balance sheet, not being very accommodative. That's going to be very, very important, and market participants and big time investors are going to be very, very sensitive to what the Fed does. So we've got to pay attention to that. Fears of a recession. Bloomberg just released an article that 70% of economists feel that we are going into a recession. People have said that this will probably be the most anticipated recession that we've ever had, right? Everybody knows that it's coming. Everybody may know that it's coming, but at the same time, people are not changing their behavior as a result. And so we're going to see what's going to be happening in the first quarter. Are we going to see a lot of layoffs coming up in Q1 that's going to increase that unemployment rate and kind of balance out the labor market? You know, is the housing market going to be even more depressed? What is going to be happening, right? Geopolitical fears due to the Russia-Ukraine war and other potential global conflicts like China invading Taiwan. You know, how long is this Ukraine-Russia war going to last? How long, you know, is Europe going to be dependent on the United States and China for their energy? That's something that we need to pay attention to. And fears of corporate earnings decreasing. Like there's going to be a lot of volatility, I feel, in January and February during earnings season, because if a lot of corporate earnings just continue to slide down and they are very, very depressed, it might not be very, very good for the stock prices of these companies. So we've got to pay attention to that. Now, what events are likely to occur in 2023? So I do believe that we will see a substantial drop in inflation next year. Many economic indicators are starting to reveal that. You know, I don't feel that we are in the recessionary, or I'm going to say the inflationary environment that we were in back in the 80s and the 70s when we had decade-long high inflation. I don't think that we are in that, and I don't think that will happen. Excuse me. Now, a recession is likely to occur in the U.S. in 2023, but the severity of the recession is unknown. And I'm not here trying to predict anything to you. I'm not even trying to predict a recession to you. And I'm definitely not going to predict the severity of the recession. I'm just giving you information that is just readily known or readily expected. Now, with that being said, the Fed will stop raising interest rates and likely cut rates before the end of 2023. If we go into a recession, that likely means that unemployment will be higher and economic growth will substantially slow. In addition, a recession would increase the likelihood of a substantial drop in inflation due to a lack of demand. the Federal Reserve will then have to support the economy by beginning to cut rates. So if we go into a recession, that further, I believe, that further intensifies, or that, like, us going into a recession further supports the argument of a substantial drop in inflation. Because if you have unemployment and you have economic growth slowing and people are not spending as much, that means that companies cannot charge as much. So that means profits will come down, margins will come down, everything will come down, right? Revenues will come down. Everything is going to come down at the end of the day. So when you look at that, that's why I really feel that this time next year, we won't be talking so much about inflation because of the things that will be happening in the economy. Now, China and emerging markets are currently in a recession, so they will likely be ready to come out of a recession sometime in 2023. Okay. In addition to that, China is expected to reopen their economy and end their zero COVID policy. So I want us to watch China. I want us to watch emerging markets as opportunities for us to trade in our portfolio. My long-term, my core holdings are not changing. My long-term core holdings are not changing. I'm looking for opportunities in spite of, right? I'm looking for opportunities in the meantime. Now, okay, so what's my rationale behind that? My rationale behind that is that, number one, there's always a bull market somewhere. There's always a bull market somewhere, and there's always going to be opportunities, right? Where are the areas in the market that are getting the love? They are right in front of our faces. We just have to look for them. If I can take advantage of the opportunities in the areas to where the market is getting love, I can get gains. I can make profit over here in the areas that are getting love, and I can then I can then add to my positions in the places in my core position that aren't getting that love. So I can then be rewarded over time. You see, hedge funds, institutions are not going to just sit back and just, say, hey, I'm just going to stay in tech throughout and just not give people returns, right? They're looking for returns. And since we've had such a bad year this year, they're not going to allow the same level of returns that they had this year to occur again next year. So we got to pay attention to all of that, and we got to look at potential ideas. Now, I personally believe, this is just my opinion, that 2023 will be a tale of two halves, okay? The market should experience extreme pessimism and likely bottom in Q1 2023 or no later than Q2 2023 due to a recessionary environment. In the second half of 2023, markets should have already priced in all negativity and will be looking forward to growth, okay? Key S&P 500 levels I want us to watch or pay attention to the downside. 3,500. That's a retest of the 2022 lows. I believe that is a significant possibility. 3,200. That is key support, and that would represent a 33% decline. Okay, that would represent a 33% decline. Now, it's very, very important for us to keep in mind that 33% decline, because that 33% decline is also in concert with the average decline of a bear market. The average decline of a bear market is around 32%, and the average length of time for a bear market is about 289 days. Now we've got the length of time in the bear market down pat. Are we good on that? We've been in the bear market for almost 365 days. So we're good on that. But we haven't had the 33% decline that would represent an average bear market, right? And a 33% decline, in my opinion, I feel would also firmly price in a recession, right? Any type of recession you want to talk about. Now, another level I want to put out here, this is a worst case scenario level, 2890. That would represent a 40% decline and signify a worse recession than anticipated. Now, I feel this is a low likelihood, less than 10% chance of happening. It could happen because we don't know, like I said, we don't know what could happen. but I do feel that 2890 is a less than 10% chance of happening. 3500, I feel that that's a greater than 50% chance of happening. 3200, probably somewhere between 30 to 40% chance of happening. So it's kind of how I feel about the percent chances of these happening, because, we got to understand that the market still moves in cycles. And we have to understand that the market historically is soft in February and March. And we also have to understand that historically markets tend to bottom in March, like they tend to happen. 2020, the market bottomed in March. 2009, the market bottomed in March. March is just one of those times. And like I said, I really haven't been able to understand why that is, why the market's weak in February and March. Why does the market tend to be weak in September? I don't necessarily know that just yet. I just know that that's just what tends to happen in the market, and the market moves in cycles at the end of the day. Now, first half 2023, what am I looking at? The market's going to be on recession watch, so expect much volatility in January and February as we digest Q4 2022 earnings from the holiday season. Also, if a recession is announced, it is likely that all stocks will be affected in some capacity. All stocks. So it doesn't matter what sector it is, all stocks can be affected. So we have to be very nimble, regardless of the sector or the company that we may be trading or investing into. Remember that the Fed will continue to raise interest rates due to inflation. So the market will probably be very sensitive to that. Now, the Fed does not have a meeting in January, but they will have a meeting in February. They will have a meeting in February, and they will have a meeting in March. Now, the meeting in March is very, very important, because that is going to be the summary of economic projections. What is the summary of economic projections? The summary of economic projections is what the Federal Reserve releases in terms of what they expect the interest rates to be, what they expect the terminal rate to be, what they expect unemployment to be, what they expect what they expect long run inflation to be. All these different things that they are expecting, they're going to be releasing that in March. Okay, pay attention. Like, that's what we got to pay attention to and keep in mind. Just keep that in mind. Go ahead and put these things on your calendar. Go ahead and look up the specific dates that you're going to need for that. Now, inflation was a buzzword in 2022, and it will continue to be in 2023, especially for the first half. The Fed will be watching the inflation data very closely, and we need to continue to stay in the downward trajectory. That is, if we hope to get out of the bear market in 2023, we've got to be on that downward trajectory in inflation. Any uptick inflation is going to spook the market. Investors are going to be very, very sensitive to that. So we got to keep that in mind. So in terms of companies, I think you should be focusing on companies that have had positive returns for 2022, have solid balance sheets, and raise their full year outlook for 2023, right? So 3 characteristics for companies you want to be looking into for the first half of 2023. Number 1, the companies had positive returns for 2022. Number 2, they have solid balance sheets. And 3, they have raised their full year outlook for 2023. So if you're raising your full year outlook in 2023, you're pretty much telling me that no matter what the economic environment is, right, they still feel good about it. So just keep that in mind on those 3 things. Now, also take a look at some insurance companies, because in a recessionary environment, I believe that insurance, like people cutting their insurance, would probably be like some of the last things that they cut. So pay attention to some insurance companies. I forgot to mention this on the slide presentation. Pay attention to high quality dividend paying companies, and specifically high quality dividend paying companies with solid balance sheets that had a positive return in 2022 and raise their full year outlook, because I feel like the first quarter, the first half of 2023 may be a repeat of 2022. So just keep that in mind. Now, while we are in the winter, pay attention to energy and utility companies, especially oil and gas. You can also trade oil and gas directly using ETFs. Now, why do I say that? We are getting into a cold period, okay? Cold period. If you have natural gas in your home, pay attention to your bill, okay? If you do not have budget billing, pay attention to how that bill changes throughout the year. During the summer, the natural gas bill is probably pretty low. It's probably low in the summer. But when you get into the winter months, the natural gas bill starts to get a little higher. And so when you look at a period from November to March, that is seasonally the period for the highest demand, right? And the highest increase in natural gas prices because of the cold weather. We're going into the winter, right? We like the entire United States is about to really truly go through a snow, like snow and cold weather, like unseasonably cold weather. That's only the start of the winter months, and that will continue to increase the demand in natural gas and will probably increase the price of oil, because oil tends to get higher during the winter months as well. So pay attention to that, especially when we are at a very, very low floor price in terms of natural gas. Just pay attention to that. So keep your eye on the China reopening and emerging markets to come out of recession. I'm going to say this again. Investors are going to be looking for yield in other places. If the United States goes into a deep recession, China and emerging markets is probably going to be coming out of a recession, right? They probably will, especially, but this is the thing, this is going to be contingent upon China reopening. A lot of institutions out there are expecting solid GDP growth from China in the 4% range, okay? The Fed, the U.S. Federal Reserve, only expects about a 0.5% GDP growth for the United States. That's right in concert with and in combination of what we would expect in a recessionary environment. So keep that in mind, okay? So you got to watch that. You got to watch that for an opportunity. Down here at the bottom, please do not forget about making investments into your core holdings during what is shaping up to be the weakest time of the year. Do not forget about the strong companies, okay? Like, we can make our money trading, but when we make our money trading, when we make our money working, when we make our money doing whatever we have to do, make sure you are putting money into your core holdings while they are down during the accumulation. Accumulate the shares now while they're cheaper so you can be able to enjoy it and be rewarded from it down the line. So, like I said, that's why I put this in bold. I don't want you to forget about your core holdings. You know what mine are: Tesla, AMD, Apple. Don't forget about the core holdings in your portfolio that you believe are going to help you be successful and gain wealth down the line. Now, second half of 2023, by the time we get the second half, it's safe to say that we will still be in a bear market that's probably been going on for 18 months, which is nearly double the average length of a bear market. But I'm telling you, the narrative in the market on January 1st will be much different than the narrative on July 1st. So we may still be in a bear market, but I'm telling you, investors are going to start to be weary. All the negative news is going to continue to come down the tape. It's going to continue to roll across the news wire. But eventually, all that news is going to eventually be priced in at some point in time. So with that being said, I expect volatility to continue in this half. It's going to be volatility all year long. We're not going to be able to escape volatility. But I believe that the growth will be the focus in this half. Growth. I really truly feel that growth will be the focus. I feel that inflation should be down considerably and asset prices should have been discounted to reflect the recession by the time we get here. In my estimation, we won't come out of the bear market in 2023, but it doesn't mean that there won't be plenty of opportunities to experience gains. For example, let's say the low for the S&P for 2023 will be 3,200, right? Let's say we hit 3,200 sometime in 2023, but at the end of the year, we end the year at 3,900. That's a 21% gain from that 3,200 level. This is what I'm going to tell you. If we come down to 3,500 and then we come down to 3,200, and let's say worst case scenario, that 2,890 number is in the back of your mind, I promise you, we won't be there for long. I promise you, you can book it. You can take it to the bank. If we come down to 3,200, we're not going to be waddling down there. We're not going to be, down there for long. We're probably going to wick down in the pre-market. We're going to have some orders at 3,200. We're going to wick down and go right back up. I promise you. So it's very, very important for you to make sure you are paying attention to these levels, right? Make sure you are continuing to add to your position. I'm not saying go all in, but at a certain time, man, shout out to the guy Lawrence, man. Lawrence from Black Wall Street Originals. He says this all the time. You got to put your bread up. Eventually, you're going to get to a place you're going to say, hey, I'm going to have to put my bread up. Shout out to him for having that saying, but just keep this in mind. Like, we're going to have opportunities even in a bear market. That's why we're looking at things and looking at ideas right now so we can be in preparation for that. Also, continue to keep your eye on the China reopening and emerging markets to come out of recession. This is the thing, China reopening. If China reopens, that's going to provide an opportunity. If they stay locked down, that's not going to provide an opportunity, in my opinion. So what's on my 2023 watch list? What do I have on the watch list? And so I've kind of got this in order in terms of what I'm paying attention to, like, as the year goes by. Now, I'm not going to stop. Now, I don't have SPY. I don't have QQQ. I don't have the Dow Jones on here. I don't have the Russell 2000, but I don't have that on here because that kind of goes without saying. I'm going to be watching the major indices all year. I'm going to continue to be watching those. So I'm just putting things on the watch list that I feel like are going to be good themes you probably want to pay attention to for 2023. So one is energy, right? So XLE, the S&P 500 energy ETF. I think that we're going to be able to have some good games, again this year because the companies are just so profitable and investors are going to be looking for safety in other areas if growth will not work. There's a possibility that growth might not work again. So if growth doesn't work again, XLE is going to be one you want to have on your watch list and be paying attention to. USO, the United States Oil ETF. Pay attention to oil. The price of oil is probably going to go higher in these winter months in the first quarter, first half. So pay attention to US oil. United States natural gas, same thing. Pay attention specifically because the demand, pretty much the normal demand that we deal with, seasonally, the price goes up seasonally, but also Europe is going to be depending on the United States and depending on China for its liquefied natural gas. So that's going to keep that demand strong, I feel. XLU is the S&P 500 Utilities ETF. XLP, the S&P 500 Consumer Staples ETF. S&P 500 XLV Healthcare ETF. These are defensive sectors. Defensive sectors can work in an environment where growth is not going to be working. So you want to have these on your watch list and see what they're going to be doing at the end of the day. Now, I've got SPDR. SPDR is just is an acronym that State Street uses. State Street Global Advisors. It's a top three investment management firm in the United States. Now, one that you might not be familiar with, TLT. TLT is the BlackRock 20-year Treasury ETF. Now, why am I watching a Treasury ETF? I feel that 2023 could be a great year for bonds. I'm going to tell you why. So, the Federal Reserve has been raising interest rates. They've been raising interest rates, historic raises in the interest rates in terms of a 12-month period. Now, if we go into a recession, and let's say we go into a significant recession, and let's say when we go into that significant recession, inflation then comes down, employment then goes up, the Federal Reserve is going to have a decision to make. At that point, they've already conquered the inflation problem at that point. So they're going to have to use their tools in order to be able to help give support to the economy. Okay. What does that mean? What that means is that the Fed is probably going to start cutting interest rates. When the Fed starts cutting interest rates, that means that we have inked in pen, we have marked in pen the peak rate for this quantitative tightening cycle, right? That peak interest rate. Now, that peak interest rate is the yield and the return that you get on your money. So if the Fed stops raising interest rates at that point, right, and pretty much interest rates continue to come down, that means that investors have faith in the economy, and they're putting not necessarily faith in the economy, but they want to have safety, right? They want to have safety, and they want to have safety, and they want to put their money into bonds, right? And what's going to happen is, I feel like the divergence between how stocks and bonds have been correlated in 2022 will diverge in 2023 if we go into a recession. Because if we go into a recession, that means we'll be in a risk-off environment, and investors are going to be trying to price that in. While they're trying to price in that recession by being risk-off and selling off stocks, they're going to be going into bonds with very, very high yields, right? Very, very high yields. This could provide an opportunity that you could ride this out for the entire year if we go into a recession and if the Fed cuts interest rates. Those are two big ifs. I would not try to anticipate this happening because you could get hurt doing stuff like that. But you should probably keep it on your watch list, have some levels that you're watching out for potential entries, because I feel that trading TLT to the upside will be very, very good because, like I said before, the 60-40 portfolio, 60% stocks, 40% bonds, the worst year we've had since 1936, right? Do we really feel we're going to have a repeat of that? I don't think so. So I really feel that bonds could be the trade of the year. Like bond returns could be outstanding next year, depending upon how the economy goes. So TLT, BlackRock 20-year Treasury ETF, trade that to the upside. That may be an opportunity if we have the right environment. Continuing on, KWEB, ticker symbol KWEB, that's Crane Shares China Internet ETF. Pure Crane Shares All China ETF, and EEM is an emerging markets ETF. Now, me personally, I don't want to spend this year. I don't want to spend a whole lot of time researching Chinese companies. Nothing against Alibaba, nothing against Tencent, nothing against Baidu, nothing against JD.com, nothing against those companies. It's just like I told you, I already know what my core holdings are, and I really get enough international exposure from my core holdings. I'm specifically talking about China and emerging markets as a trade for next year because the markets have been so depressed. And if China is expecting 4% GDP growth, while the Federal Reserve is expecting the United States to have 0.5% GDP growth, that's going to provide an opportunity if and only if China reopens and ends the zero COVID policy. That is the caveat for China and emerging markets. Now, BlackRock, so ticker symbol IAK, is the BlackRock US Insurance ETF, and KIE is the SPDR S&P 500 US Insurance ETF. Pay attention to the insurance companies in that ETF. You're probably going to find a few companies in those ETFs that had positive returns in 2022. These companies are probably going to do pretty well in 2023. They're probably not going to change that much. So I have them on my watch list because they may provide opportunities for me. Now, 2023 watch list continued. I've got Apple. I've got AMD. I've got Tesla. I'm not letting go. I'm not letting go of tech because I'm going to be adding to my positions as the year goes on. I'm going to be adding to my positions because these companies are just, the prices are too good and the fundamentals are just too good not to pay attention to these companies. So, those are my top three in my portfolio I'm paying attention to. Let me introduce some leverage into your life. So ticker symbol SOXL, the 3X leverage semiconductor ETF, TQQQ, the 3 times leveraged NASDAQ ETF. Now, these are some ETFs that have been depressed, that have been beat to sleep. These ETFs are pretty cheap. Last time I looked, I believe SOXL was around $10 to $12. TQQQ was around $18 to $20. So if the S&P does come down to 3,500 or 3,200, that's going to put the ETFs in terms of like where the prices of them in concert with lows that we had in 2018, lows that we had in 2020. So if you can build a position in a 3 times leveraged ETF in a bear market, it's a potential you could buy some of these stocks at like $5 or maybe $10, buy a substantial amount of shares and just ride it and just let it sit, because we probably won't be coming back down to those prices because eventually we're going to get out of this period. So the 3 times leveraged semiconductor ETF and the 3 times leveraged NASDAQ 100 ETF, I believe you should really, truly consider that for your portfolio. Just consider it. I believe it's going to be an opportunity. It's going to go up 3 times as much as these stock prices go up. It's going to go down 3 times as much. But with the volatility comes the opportunity, especially if you can get it at the bottom in a bear market. You will be rewarding yourself in 5 years. I promise you. I promise you, you'll be rewarding yourself. And XLK, XLY, SPDR S&P 500 Technology ETF, SPDR S&P 500 Consumer Discretionary ETF. These ETFs aren't going anywhere. I'm going to be continuing to watch them for potential opportunities if we come out of this environment. Like, the opportunities are going to be here to really, truly make some good investment / trades in these ETFs once we get out of this environment. So this is my watch list. Just keep that in mind for everything that we've got going on. So, that's what I've got for my 2023 stock market outlook. Those are the things that I want you all to pay attention to. Remember, 2023, anything can happen. Anything can change on a dime. And for me, what I'm focused on doing for the Trade for Yourself podcast is 2023, giving you all more ideas. You don't necessarily have to take my ideas because I'm not a financial advisor, nor am I a fiduciary. Investing comes with considerable risks. Make sure you have a financial advisor for any financial instrument that I discussed or any ones you want to get into. I just want to provide different ideas that I may be getting into that may provide some opportunities for us this year, next year, and years beyond, because you want to keep adding tools to your toolbox because you want to know what works in certain environments. Because I'm telling you, once we get out of this recession and we get back into a bull market environment and we're back to all-time highs, we're going to have another bear market again. You can book it. Like, we're going to have another bear market. So you're going to want to know what's going to work during those markets and you might as well learn now, right? You've got the time. You've got the time. You want to be an active investor. You want to build wealth. You want to, trade for yourself. You want to do those types of things. So in order for you to do that, you might as well take the time and learn what you need to learn so you can be successful in 2023, and 2024, and 2025, and 2028, and 2030. So again, make sure that you guys please like this. Please subscribe. Thank you for tapping in. Reach out to me in the comments, guys. This is episode 49. Okay, episode 49. Episode 50 will be next week. It will be a treat. Please. Thank you again, as always. And remember, don't pay for it. Trade for it. I'm going to tap in with y'all next week.